Global stocks rally on growing hopes the Fed will cut next month. Donald Trump threatens even higher tariffs on India, blaming its buying of Russian oil. And Australian house prices are rising at an annualised rate of 7.4%. That's coming up in our 5 Things in 5 Minutes on Tuesday, August the 5th. And in our deep dive interview, ANZ economist Vicky Xiao analyses the ongoing trade talks between China and the US.
We think China's export in the second half of the year will moderate, but will not have a sudden drop. And then the main focus for China is still the domestic story.
But first, in 5 and 5 with ANZ, US and European stocks rose between 1% and 2% overnight on growing hopes the Fed will cut interest rates next month. That's largely because of those weak jobs figures on Friday. Meanwhile, there's fresh trade turmoil with Donald Trump threatening overnight to raise tariffs on India beyond the 25% signalled on Friday. He blamed India's ongoing buying of Russian oil and accused India of profiteering by buying it cheaply and selling it onto global markets. As of 4 a.m. Sydney-Melbourne time, the Euro Stoxx 600 closed up 0.6%. The S&P 500 was up 1.3% and the Nasdaq up 1.8%. The US Treasury yield, the 10-year, fell another 2 basis points to a 3-month low of 4.20%. Gold rose 0.8% to $3,427 an ounce on those lower rates, while West Texas oil futures fell a further 1.4% to $66.40 a barrel. That's after that big production increase from OPEC. The US dollar index fell 0.3%. The Aussie dollar was also down 0.2% at 64.61 US cents, and the Kiwi was down 0.3% to 59.01 US cents. Number 2, Australian house prices rose 0.6% in the month of July. That's the third such rise in a row. ANZ Australia economist Maddie Dunk says the market's momentum is continuing after rebounding in February when the Reserve Bank of Australia started cutting rates again. It had held them flat all through 2024.
The market was looking quite soft, but following February, we've seen this broader recovery in capital city housing prices. And at the moment, if I look at the last 3 months, growth in housing prices across the capital cities is annualising at 7.4%. So well above the 10-year average and pointing to pretty solid growth, particularly if we look at some of those forward indicators like auction clearance rates. They do suggest that housing prices are going to continue to move upwards.
Number 3, Maddie says the price growth has been strongest for the cheapest quartile of homes in Australia.
So we've been continuing to see that cheaper properties are reporting stronger housing price growth. That's been a trend for quite some time. We did see when the RBA cut rates that those more expensive properties recorded a stronger lift compared to some of those cheaper properties. But since then, the trend has reverted back to those cheaper properties.
Number 4, New Zealand is scheduled to get fresh labour force figures tomorrow, which ANZ New Zealand chief economist Zhou expects to be quite soft.
It's likely to be a pretty sad story, I would suggest. We've got experienced employment in our business survey questionnaire now, and it's slipped right through the month. Job ads have been going nowhere, but also filled jobs. The IRD data has been soft as well. So lots of things pointing towards a pretty weak labour market in the second quarter. So we are actually expecting that employment fell 0.1% in the quarter, which sees the unemployment rate lift 0.2 percentage points to 5.3.
Number 5, New Zealand's consumers see inflation of over 5% in the next year. So might that force the Reserve Bank of New Zealand to keep rates on hold? Sharon says no, in part because the current high inflation of food and electricity prices is taking pressure off inflation elsewhere.
You could even argue that the inflation and the cost of necessities could be reducing discretionary spending to the extent that it's actually a disinflationary impact on those prices that are impacted by the state of the economy. Obviously, inflation doesn't solve inflation. So the argument that high inflation will make people spend less, which will bring inflation down, that just does not hold water over history. You can see that, or we wouldn't have had the 1970s experience. But in the context of where the economy is here and now, I don't think the Reserve Bank needs to worry about consumer inflation expectations. They don't get to set prices, and firms are finding it very difficult to pass cost increases through. So households might be expecting high inflation, but that doesn't mean they will accept it when they go to a shop and see the price has gone up. They're likely to turn around and walk straight out again.
Sharon Zollner there. Now, in our deep dive interview, ANZ economist Vicky Xiao navigates the ins and outs of China's still unresolved trade talks with the US.
Based on the outcome of the 3 rounds discussion, and we have observed that the subtle shift in tones of officials from both sides, from in Geneva talks being very generic to very focused and assertive in the recent Stockholm meetup. This signals that the official interactions between the two sides are becoming increasingly difficult, and we believe there are still a long way to go to reach a final agreement between China and the US. And we anticipate there could be a presidential summit in the coming months, and that will lay the foundation for the final deals.
Apart from the general tariffs on trade between the two, there are a couple of types of exports, rare earths and chips, which are quite prominent. Could you talk a bit more about the role they play and what's going on there?
Our core view for China and the US trade talks, the nominal tariff rates are not important anymore, and then people are more focused on the key trading items like rare earths, minerals, and chips. And then for the rare earths trade, we have observed that in July and in June, the rare earths going to the US increased by nearly 4 times, but this is still substantially lower than the level in 2024. But China has been very clear that they will lose the restrictions on rare earth minerals for civilian use, but they still hold tight controls for critical minerals for weapons and military use. And we can see that in the export data. On the other side, the US has loosened its control for chips export going to China, and we've seen NVIDIA received the permit to export H20 chips to China. But we should notice that these chips are less advanced, and we hold a very cautious view that interpreting this action as the US is going to lift the tech ban on China overall.
And what about LNG as a way in which this trade deal could be reached? Because in the past, China has been a major importer of LNG from the United States.
Yes, the energy trade between China and the US almost dropped to zero, including China's import of coal, energy, and other type of energy products. During the first trade war, US did request China to import more US energy products. And then we believe this time US will bring this topic to the negotiation table again with China, and then require China to buy more US energy products. And then from China's side, it is likely that China will agree on this and then buying more US product as a strategic compromise.
What's the current view on how these trade restrictions and tariffs might affect growth for China in the next couple of years?
In the domestic discourse, I believe the trade war is not the center topic anymore. Domestically, China has launched this anti-involution campaign, try to curb China's deflation, which has been going on for the past 2 years. And then on the trade front, we still believe that it is quite difficult to remove China from the global supply chain. The trade deal US reached with other countries could pose some disruptions to China's export, but the details and the implementation of those trade deals might take time to finalize. So we think the China's export in the second half of the year will moderate, but will not have a sudden drop. And then the main focus for China is still the domestic story.
Vicky, Xiao there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, August the 5th. Catch you tomorrow with a closer look at the risk of labour hoarding in New Zealand. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.